Liebe Zuschauerinnen und Zuschauer, heute werfen wir einen exklusiven Blick auf die Investmenttrends für 2025. Ein Thema, das nicht nur hochaktuell, sondern auch von entscheidender Bedeutung für alle ist, die zukunftsorientiert investieren wollen. Wir leben in einer Zeit des rasanten Wandels. Technologische Innovationen, die fortschreitende Digitalisierung und die wachsende Bedeutung erneuerbarer Energien sind nur einige der Megatrends, die unsere Investmentlandschaft maßgeblich verändern werden. Inmitten dieser dynamischen Entwicklungen eröffnen sich nicht nur Risiken, sondern auch große Chancen. Wer die richtigen Trends frühzeitig erkennt, hat die Möglichkeit, sein Portfolio zukunftssicher aufzustellen und von langfristigem Wachstum zu profitieren. Um Ihnen heute einen fundierten Einblick in diese Entwicklungen zu geben, haben wir zwei ausgewiesene Experten eingeladen. Sie werden uns einen umfassenden Überblick über die wirtschaftlichen und geopolitischen Faktoren geben, die 2025 und darüber hinaus von zentraler Bedeutung sein werden. Dabei werden wir nicht nur die aktuellen Markttrends beleuchten, sondern auch konkrete Strategien vorstellen, wie Sie als Anleger strategische Chancen nutzen und potenzielle Risiken absichern können. Und damit wünsche ich Ihnen einen schönen Mittwochabend, liebe Zuschauerinnen und Zuschauer, sowie ein herzliches Willkommen zum vierten und letzten Teil unserer spannenden Finanzen-CH-Seminar-Reihe, den Swiss ETF Investor Days. Mein Name ist Jasmin Menzin und ich darf Sie in den kommenden 60 Minuten als Ihre Moderatorin durch die heutige Veranstaltung begleiten. Ich freue mich sehr, dass Sie alle heute mit dabei sind und sich bereits so zahlreich eingewählt haben. Und genauso sehr freue ich mich, unseren heutigen Gast in dieser Runde nun begrüßen zu dürfen. Guten Abend und herzlich willkommen, Alexander Roll und David Osols. Schön, dass ihr heute Abend bei uns seid.
Hi Jasmin, wir freuen uns.
Bevor wir in euren Vortrag einsteigen und ihr euch dem Publikum noch genauer vorstellen könnt, möchte ich Sie, liebe Zuschauer, noch auf Folgendes hinweisen. Bei Fragen oder Verständnisproblemen können Sie uns während des Webinars über die Chatfunktion kontaktieren. Einige Ihrer Fragen werde ich möglicherweise direkt aufgreifen und an unsere Experten weiterleiten. Am Ende der Veranstaltung wollen wir in einer Fragerunde gemeinsam noch offene Fragen klären. Außerdem noch die Anmerkung, der Hauptteil der Präsentation von David und Alex wird auf Englisch sein. Da beide Referenten aber ausgezeichnet Deutsch sprechen, können Sie Ihre Fragen gerne auf Deutsch stellen. Nun haben wir Sie, liebe Zuschauer, aber genug auf die Folter gespannt. Wir haben heute Abend noch einiges auf dem Programm. Wir wollen dann auch direkt loslegen. David, ich ernenne dich zum Moderator. Euch gehört die Bühne. Du kannst dann die Präsentation übertragen und mit eurem Vortrag beginnen.
Okay, super. Ihr seht alle meinen Screen?
Ja, wir sehen ihn in Vollbild.
Super, also ich stelle uns erstmal vor. Mein Name ist David Osols, ich bin Teil des europäischen Vertriebsteams hier bei Global X. Ich persönlich möchte erstmal allen danken, dass ihr alle heute hier seid. Wir freuen uns sehr, ich und Alex. Heute habe ich auch die Freude, mit unserem Investmentstrategen Alex zu präsentieren. Der Alex bringt eine beeindruckende Erfahrung mit sich, alles bezüglich Investment Selection und Aktienanalyse. Wir werden heute einige Themen besprechen, auch einige Fonds von uns anschauen. Jedoch denke ich, ist es besser, wenn wir, also beziehungsweise ich, uns etwas über Global X erzähle, wie wir gestaltet sind und was wir eigentlich zu bieten haben. Okay. So. Global X ETF wurde im Jahr 2008 gegründet und mit Hauptsitz in New York. Seit über 10 Jahren setzen wir uns quasi dafür ein, Anlegern innovative und durchdachte Anlagemöglichkeiten zu bieten, die ich uns immer gerne vor den Kunden positioniere und unsere Alleinstellungsmerkmale als ETF-Anbieter darstelle, ist quasi so in zwei verschiedenen Säulen. Als erstes unser klarer Fokus auf das jeweilige Thema. Wir vermeiden gerne Mischkonzerne in unseren Baskets, damit Anleger das Thema in seiner reinsten Form verstehen. Unser internes Research-Team macht ungefähr 25% unserer Belegschaft aus und ist nach Themen gegliedert. Unsere Analysten kümmern sich dann um jedes Subthema, für das wir Produkte und Insights auch publizieren und anbieten. Das Team ist auch entscheidend bei der Entwicklung von der Indexmethodik sowie bei der Auswahl der Aktien. So, das ist die erste Säule. Die zweite Säule ist unsere Erfahrung in der Einführung von ETF-Lösungen auf globaler Ebene. Wir sind immer bereit, Marktlücken zu schließen, sei es bei Themen, Einkommensstrategien oder Optionen. Ein Beispiel dafür zum Beispiel ist, dass wir die ersten Covered Call Strategien nach Europa, also beziehungsweise in einem ETF nach Europa gebracht haben. Und wir haben auch auf der Rohstoffseite den ersten Uran-ETF nach Europa gebracht und über beide Produkte wird Alex noch im Laufe des Webinars sprechen. Wie wir das machen im Hause bei uns, wir bieten Produkte zu einer relativ breiten Palette. Wir haben eine große Income-Sparte, eine Thematic-Sparte, sowie eine Commodity-Sparte und eine optionsbasierte Sparte. Aber die entscheidende Frage ist, wie entscheiden wir uns eigentlich für ein Thema? Da gehen wir meistens in 3 Schritten vor. Als erstes Conviction. Wir suchen nach säkulären, strukturellen Veränderungen in dem Bereich Disruptive Tech, zum Beispiel Cloud Computing, Cyber Security, KI, People and Demographics, das ist so ein bisschen unsere Konsumsparte. Da schauen wir uns Themen wie Telemedicine oder E-Commerce an und dann Physical Environment. Das ist so ein bisschen unsere nachhaltige Sparte. Aber wenn wir uns erstmal das Thema Conviction überhaupt anschauen, es basiert oft darauf den Reinheitsgrad zu priorisieren, anstatt das Kapital auf viele verschiedene Bereiche oder Firmen zu verteilen. In der Regel konzentrieren sich Anleger dabei auf einen großen Teil ihres Portfolios auf eine Handvoll Aktien oder Vermögenswerte und genau das bieten wir an. Wir als Global X suchen nach Pure Play, Unternehmen, die sich intensiv mit bestimmten Themen beschäftigen. Unsere Index, um ganz ehrlich zu sein, unsere Indexmethodik ist auch so konzipiert, dass es im Prinzip anders gar nicht geht. Das bringt mich aufs zweite Thema und das ist bei uns Investability. Wir filtern meistens nach Unternehmen, die eine Mindestumsatzschwelle von 50% aufweisen. Was schaffen wir dabei? Wir vermeiden damit durch Mischkonzerne. Das heißt, die typischen Teslas, Apples unserer Welt sind nicht in jedem tech-orientierten Fonds von uns mit drin. Dann schauen wir uns, also wir sind Market Cap weighted, das heißt, wir schauen uns die Mindestmarktkapitalisierung an, die in der Regel bei jedem Fonds auf 8% begrenzt ist. Genau, und dann haben wir verschiedene Liquiditätsbeschränkungen, um Aktien in unserem Fonds aufzunehmen. Das heißt, eine Aktie muss mindestens eine Mindestmarktkapitalisierung von 200 Millionen aufweisen. Genau. Dann, diese Grafik wollte ich noch kurz präsentieren. Wir positionieren Themen, was wir in-house nennen, auf einer S-Kurve. Das heißt, jedes Thema hat zwar seine eigene Adoptionskurve, aber die folgende Grafik zeigt, in welcher Phase sich verschiedene Themen befinden. Wie Sie sehen, weniger entwickelte Themen stehen weiter links auf der Kurve und bringen sowohl ein höheres Risiko, aber dadurch auch potenzielle größere Gewinne mit auf sich. Und etabliertere Themen wie zum Beispiel Social Media oder Cloud Computing sind weiter rechts auf der Kurve zu finden, weil die Themen, die haben sich mittlerweile entwickelt. Genau. Und als letztes von meiner Seite aus, bevor ich auf Englisch wechsle, das ist unsere Usage bzw. OGAF-Sparte. Wie Sie sehen, wir haben eine Menge thematische Produkte zu bieten im europäischen Markt. Wir teilen es, wie gesagt, auf. 3 verschiedene, ganz klar und einfach, 3 verschiedene Sparten. Eine Disruptive Tech-Sparte, eine Sustainable Physical Environment-Sparte und eine Konsumsparte. Dann haben wir auch 3 Rohstoffprodukte, wo wir uns auf Minenbetreiber, Bergbau fokussieren, zu Kupfer, Uran und Silber. Und eine breitere Income-Sparte, wo wir uns quasi auf High Yield und monatliche Ausschüttung fokussieren. Und somit, I'm changing to English to pass over to my dear colleague Alexander Rowe.
David, Alexander, darf ich ganz kurz einschreiten? Ich bekomme leider gerade die ganze Zeit schon Nachrichten, dass man euch sehr, sehr schlecht versteht. Vielleicht könnte Alex, wenn er jetzt gleich auf Englisch fortfährt, zumindest ein Headset aufsetzen, um ihn ein bisschen klarer zu verstehen, wenn es möglich ist. Liebe Zuschauer, vielen Dank für Ihren Hinweis, dass die Tonqualität gerade nicht so gut war. Ich denke, die Referenten schauen gerade mal, was da technisch noch machbar ist und dann können wir hoffentlich direkt verfahren.
Hello, hello.
So, wunderbar. Ich glaube, jetzt ist der Ton besser.
Okay, great. So we left off. Yeah, thanks to David for the initial presentation. I'm going to do this in English. So I'm going to cover a few topics that are relevant to kind of the upcoming US election, touch briefly on some themes, but then also spend more time deep diving into cover call strategies and buffer strategies, which are part of our fixed income range of products. So in terms of just the elections, we looked at past historical data of the last 3 elections, and what one can see is that generally, a month prior to 1 to 3 months prior to an election of the past 3 elections, volatility does increase quite a lot. Now, obviously, we've had a very strong market where, obviously led by technology, communication services throughout the year. There's been a bit more of a broad market participation in Q3 as witnessed by more equal weighted indices such as, S&P equal weight. But, there's a few signs that maybe, in the coming weeks, as we get closer to the election, there might be some increased volatility again. It's just something to be mindful also given other geopolitical factors, etc. One theme that is really one of our flagship products, and we've had for quite a long time in the US and also launched as UCITS in Europe, is the US Infrastructure Development ETF. So this is a basket of ETFs that really targets the themes that are kind of driven in the US in terms of companies that are benefiting from all the fiscal bills that have been enacted over the past few years, specifically under the Biden administration, such as the Inflation Reduction Act, CHIPS Act, Infrastructure Investments and Jobs Act. What we've seen since kind of the COVID period is that, the US is really going through a new manufacturing boom. And, we could really see industrial production break out even more. A lot of these fundings of these bills is really going towards manufacturing, but also into all kinds of sectors such as semiconductors, renewable and clean energy, EVs, etc. So really trying to digitize and expand the economy, and that's also reflected in the growth that the American economy has seen versus, the rest of the globe in terms of their GDP output, and also reflective in the markets. What you can see on the left-hand side is, kind of project funding types into specific areas from the IIJA Act. So a lot is also, for example, going into water, clean water technology, as regulation has been passed in the US to kind of remove clean forever chemicals in pipes and water. So there's going to be more investment into the space, also replacing water pipes, etc. Because as you can see on the right, a lot of infrastructure generally in the US is averaging around 50 years. So there needs to be much more investment into maintenance as well as renewal of things. Basically, over the last couple of weeks, an association in the US that's responsible for transport also measured that around over 200,000 bridges in the US will require some form of maintenance. We've recently seen how the bridge in Baltimore collapsed. So, more funding it will expect it to be going into this space. And in terms of thinking about the election as well, there's a lot of discussion as to, whether these bills might be affected if, say, like Trump gets elected, given that, a lot of these policies have been enacted throughout the Biden administration. However, one needs to be mindful that it is a bipartisan agreement by both parties, as the House and Senate both agreed on these. And, I don't think there will be any amendments to any of sorts, as these are long-term agreements that have been enacted by law, right? Jumping to another topic, obviously it's a lot of the ETF basket here. This is an ETF really that has approximately up to 100 names, and it's really focused quite a lot on industrials and materials, but it's really the enablers of the projects that are taking place in the US that are primarily funded by the aforementioned bills, fiscal bills. You'll also find a lot of companies that, for example, even help to construct data centers in the US or work on the connectivity of such data centers. Hence, the performance has been quite strong on this and steady and surely over the years. Another thing that is quite linked to what I just mentioned now is also the uranium market, right? We're hearing a lot in the news, especially over the last week, in terms of major tech companies signing deals to source their energy and electricity needs from nuclear energy providers. For example, earlier this year, we've seen, for example, Microsoft agree with a Texas-based energy company called Teil Energy that will, over the next 10 years, produce energy from so-called SMR reactors, and it's planned that more will be installed to fuel certain data centers. Just yesterday, Google also announced, I forgot the name of the exact company, but that Kairos Energy actually, that they will be sourcing energy from future planned SMR reactors. I believe even, Citadel today announced that they will be they are invested in some sort of deal with SMR reactors as well, and will be trying to export that energy, etc. Anyway, just leaving and not going too micro, just leaving it on a macro level as well. If you look at kind of the energy mix globally, China, for example, they're planning to build 10 nuclear reactors each year. The US is obviously very strong in this, given the data center boom I mentioned recently. Logically, in India, given the population size, the demographics, the strong GDP growth that's happening, and industrialization in that space, they will require loads of energy, and it's being targeted strongly by the administration in India. Even in countries like Japan, which completely shut their nuclear operations post the Fukushima disaster in 2013, are starting to reopen certain nuclear reactors again. So there's a lot of macro tailwinds behind this theme. Specifically on small modular reactors as well, for those that aren't maybe too aware of it, it's basically a new technology of a reactor in that they can be kind of prefabricated in factories and then installed at the specific site at a much faster rate. So, typically it would take more than 4 years for a normal nuclear reactor to be fully operational. With SMRs, currently, I believe it's around 18 months from sources we've seen, but it will possibly be even reduced, as most of the stuff will be constructed in factory, and then it will be more a matter of bringing the pots together at site and making something operationally safe. Here on the slide, it just gives you a bit of an indication. It's quite a short-term chart on the top left. Nonetheless, the uranium price throughout 2023 really kind of started its bull run, where it started, I believe, as low as like 30 per ounce of uranium and went up to 100. This has stalled somewhat during 2024, as there's been a bit of a correction during summer, as it's been a very kind of high beta link theme to the market. We've just experienced some more volatility in general. Nonetheless, recently, there's a strong comeback in uranium and uranium-linked stocks. And one thing to be mindful as well is due to the U.S. ban on Russian enriched uranium exports has also fueled kind of a supply crunch on the enriched uranium side, which has actually provided a bigger rally in the enriched and concentrated uranium market, where also you can find companies that benefit from that. Just in general as well, on the right-hand side, you can see these are the ETF flows across all the European UCITS assets in Europe. So there's been obviously a real strong kickoff throughout 2023 and continues in 2024. Where the flows have been strong and linearly trending. Just again, looking a bit at power generation, these charts from China, US, India, France indicate that, this year actually the generation from such sources has been above the 5-year average. So it also makes the case that, this is being utilized much more as an energy source. With that said, I'll conclude on the thematic side and delve a bit more into our fixed income suite. So just to start off with, covered call the NASDAQ 100 covered call is a strategy we've had about almost 10 years in the US. It's actually our largest fund in the US, where we manage 8 billion in AUM. We've launched this product at the end of 2022 and now run 250 million in assets for the UCITS ETF. So what is a covered call? For those who aren't familiar, a covered call strategy is a strategy where you can write options to generate a yield on an asset that you already own. So, for example, it can be a stock or an index. In this case, for the NASDAQ 100, you would be long the NASDAQ 100 and you would be writing a call option. And if the market price does rally, goes higher, your performance would be capped based on the strike price that the option is exercised. On the downside, you would take losses like the equity market, but that loss would be buffered based on the premium that you collect from writing the call option. So in terms of our product, so as I mentioned, it's long the NASDAQ 100 index, and it simultaneously sells monthly at the money European style call options each month. So it's rolled every third Friday of the month. It's entered into a new option contract for 1 month, selling the option at the money. The expense ratio for this product is 45 basis points. The swap fee is 0. To mention as well, in the US, we've done this physically where we sell the call options. In Europe, we've replicated the strategy synthetically, whereby we enter a total return swap with our counterparty, Citibank, who provide us the performance of the CBOE, so Chicago Board of Options Exchange, NASDAQ 100 buy right index. So the buy right index is basically the index that tracks this strategy where it writes the monthly calls and is long the NASDAQ 100. So via the swap that we enter with Citibank, they provide us the performance of this index. And in exchange, we hold a basket of equities that basically holds MSCI USA securities that have a close beta to the NASDAQ that we exchange in performance. And this is there obviously as collateral on the swap. It is an unfunded swap by nature, one thing to mention as well. So in terms of looking at hypothetical performance scenarios with covered calls, so in this, just assuming here in the diagram on the left-hand side, say you're rolling into an option where the strike price of the call allows for, say, a 4% premium, just hypothetically. So if the market rallies and you're long this covered call strategy, you can basically perform on the upside until 4%, but you will give up for the upside if the market rallies more during this 1 month period. So you basically underperform the market. If the market goes sideways and kind of closes at the same price as it did at the beginning of the option roll date, then you would tend to outperform the market. Also, if it rises maybe 1-2% as the market is basically flat, but you're receiving the premium from selling these call options. In a downtrending market, you would outperform the index. You will take downside, but you will outperform by the premium basically that you receive, which you don't, as it's higher than the NASDAQ. Just one thing to clarify on the share class as well. It is an accumulating share class on QLD, but it has a distributionary function as part of the premium that's collected on a monthly basis. But the function of this, the payout, the yield that you get like a dividend in nature, is the lower of half the premium received in that month or 1% of the net asset value of the strategy. So if, say, you write the call in a month at expiry, the premium collected is 3%. The payout will be capped at 1% based on the function I just mentioned, and the remaining 2% will be reinvested into the strategy. In this scenario on the right, where you have 1.5% option yield, you will be paid out a yield of 0.75, and the other 75 basis points will be reinvested into the strategy. So just looking at fixed income in general, typically investors will always try and hunt for yield by, extending their duration profile on the treasury curve, or looking for higher credit risk, sub-investment grade, higher yield bonds, emerging market debt. But if we just look at the 12-month historical yield of such a product, we actually see that covered call strategies actually have provide a higher yield than the aforementioned products, simply due to that you're monetizing the volatility of these options. Just as a reference here, the 11.2% is the 12-month trailing yield of QLD, which is the Nasdaq 100 cover call strategy, and XYLU is the S&P 500 cover call strategy, which yielded 8.4%. I have not mentioned this, but as you can see on the next slide, it's a like-for-like product in that it's structured exactly the same way, where we have a swap agreement with Citibank that tracks the CBOE S&P 500 buy right index. The only difference here is that on the unfunded swap, due to the cost of nature and dealing in the security, the swap fee is actually -7 basis points. So the total expense ratio is actually 38 basis points. Just looking at historical premiums, obviously option premiums are closely linked to underlying volatility, given that volatility as a vega is an input into option pricing models. And if you look at the 2-year average on Nasdaq 100 covered calls, the average premium was 2.4%. This has gone as high as 4.4% during periods, when there's more bearish markets, like in 2022, when volatility is elevated, option prices are higher, and as we're selling option in the strategy, it will generate a higher yield. In more volatility compressed bullish markets like 2023, you've seen a minimum yield of roughly 1.8%. Generally, it will always be around over 2%, hence the strategy almost yields 12% annually, 11 to 12%. For XYLU, which is the S&P 500 cover call strategy, this is naturally lower, given that the VIX, the volatility index of the S&P 500, is lower than the volatility index for the Nasdaq, just given that it's more diversified in nature, and the Nasdaq is more tech heavy. So here the average over the 2 years has been 1.75% in terms of option premium per month. One thing to think about how the strategy could really fit into a portfolio is that we've purely viewed as a yield enhancing strategy, so it's more a fixed income strategy. It could typically also equity investors will look at trying to enhance yield by looking at high dividend strategies. These are typically often found in sectors such as that are quite cyclical, like financials, REITs, utilities that offer high dividends. But in certain periods, even these dividends are not necessarily guaranteed, like we've seen during COVID. There's been a lot of dividends being slashed or reduced to such periods. And a strategy like this can just add something different with exposure to tech, but more harnessing the volatility to get a fixed income yield. At the same time, if you already have exposure concentrated towards tech, communication services, this can be a complement to just extract yield on from say the Nasdaq 100, because the dividend yield on that is quite low. This is another interesting chart which just shows over the 10-year period since the index, the CBOE Nasdaq 100 index was available back in 2015, the annualized return against the downside volatility. And what you can see is obviously more on the down left side, you can see classical fixed income, higher yield, obviously a lower downside volatility given the nature of fixed income. And also a bit lower returns than the cover calls. What's interesting is that compared to like global equities, which are here depicted by the MSCI ACWI index and US dividends, cover calls don't almost provide a similar return, slightly less especially for the SP covered call, but it also at the same time provides a lower downside volatility. So it can kind of, combine a bit of this exposure to equity in terms of, having exposure to the NASDAQ, but at the same time, generating a high yield and fixed income. Just as a general point out as well as like for the NASDAQ 100, the beta over the 2 years has been at 0.38 to the market, to the NASDAQ. So you are also participating partially to the upside in that, every month when you roll, the market is a bit higher and therefore the option notional becomes higher, right? With that, I will switch it to other products that we have launched over the last 1-2 years, which are specifically our defined outcome products. So one of them is the Global X S&P 500 quarterly buffer. So defined outcome strategy is really more of a risk managed product in that it allows you to participate in the upside of an asset, such as the S&P 500, but you can buffer some of the losses on the downside. So the way it is constructed is that you maintain one like-for-like exposure on the S&P 500. You enter a at-the-money put option at the roll date, and at the same time you sell an at-the-money put option 5% away from the S&P level at the option roll date. So you create this defined outcome range where it buffers the 5% via the put spread. At the same time, you will sell a call option on the S&P 500 out of the money as high as possible that the put spread basically allows you. So you will have to purchase the put spread, and that cost can be retrieved back from selling the call option. And we will obviously sell as high as possible to make the option strategy a net zero cost strategy. And then naturally, obviously, the upside will be capped based on the strike price of where the call option sold is struck at. So just to clarify this a bit more as well in terms of performance. So the quarterly buffer is, it's rolled. The option contracts are rolled every quarter of January, April, July, and October, and it sets the 5% buffer at that roll date based on where the S&P 500 is at that roll date. So in terms of on the left, as you can see, if you assume a 6% upside based on where the call option strike is sold at, 6%, say that is the cap, then if the market rallies 9%, you will be capped at 6%. If it rallies 3%, you will gain all the upside because it hasn't reached your 6% cap. On the downside, if the market tanks 3%, you won't incur any losses. If the market drops 7%, you will mitigate the first 5% of losses, but then after that, you will take the additional 2%. In terms of the products we have on defined outcome, we actually have 4 in total. So the quarterlies have been most popular with flows in terms of the first one, which I alluded to, the quarterly buffer. So this has a 5% buffer. We have a different version, which is a quarterly tail hedge. So it's the same concept. It's just that the buffer is 9%. And it works that the options are struck on the put spread that you would incur the first 3% loss on the downside, and then the buffer kicks in, the 9%, up to 12%. That loss would be mitigated. For the annual buffers, these are only struck, the options are only struck once a year on the 1st of January. These are more a tool if people do really think there's a severe correction coming in the market. So there we have the annual buffer, which on the downside protects 0 to 15%. And then we also have the extreme scenario of the tail hedge that is structured where you take the first 5% loss, but then there's the buffer of 30% that buffers up from 5 to 35% loss. One thing to mention about all of these 4 strategies as well, it's similar to our synthetic covered call strategies, is that they are based on a swap, again, with Citibank or counterparty, whereby they swap the performance of these indices, of these strategies, against the basket, again, of MSCI USA securities that we hold as collateral, which are closely linked to the beta of the S&P 500. All these strategies are at a 50 basis points total expense ratio. But again, for these specific S&P 500 strategies, the swap fee is -7 basis points. So all in, you're all in at 43 basis points. Just also looking kind of at the investment case of where these kind of strategies could be useful is, obviously a lot of people have been quite concerned about the high concentration in the indices, specifically NASDAQ or the S&P, that, the rally throughout the year has been very strongly fueled by the Magnificent Seven, the top tech firms. And what we once again see is that, bond stock correlations remain very high at 0.8. And based on kind of recent sell-offs we've seen in COVID, also in 2022, the problem has always kind of been that, bonds and stocks really do kind of correlate on the downside. Many assets do, right? And a strategy like this, where is more also a risk reward tool, where you think, okay, I'm not sure where the market is going now, maybe because of geopolitical events, maybe the US election. It allows you still to participate in some upside. 4% is roughly usually the upside cap on the S&P quarterly buffer. So you can still get this short-term upside for the quarter, but at the same time, if you feel maybe there's a correction, you're buffered to 5%, or if you go into a more tail hedge instrument. So you can, the nice thing with it is you don't have to actively manage the option or decide when to buy it or not. You can keep it quarterly, and it will say if the market does continue to rally, at the next reset, you will again have this kind of risk reward trade-off where you have a bit of upside that you can participate in, but you can mitigate the downside if you're uncertain about markets. The tail hedge strategies you can also more use if you think there will be a deeper correction. But then even if you're wrong, you still have a bit of upside. So in that sense, it's a tool more for uncertainty. It can also tactically be used intra-quarter, where say if during the quarter maybe 1.5 months have rolled off, and it's actually rallied up to the cap, where you don't have more upside participation. But then suddenly there is a correction. And it goes back down to the level in the index where the product has basically been initiated at the roll date of the options, where it's like where you're not sure, okay, maybe there's more downside to follow, but it could also bounce. It may be a tactical tool to then enter, because you then have that dynamic of, okay, we have had a correction, but maybe it's going to fall another 5%, then you're kind of buffered, but you can also get the upside, obviously up to a cap, but in a more range-bound market with volatility, maybe that might be a suitable product. With that said as well, I mean, the products, defined outcome products, are really more of a tool also to diversify your 60/40 portfolio. It can be part of an equity sleeve in the portfolio, mainly to reduce equity beta on the equity side. And with that, I'll conclude the presentation. I thank you very much for listening, and I hope you enjoyed it. I mean, I'll open the floor to Q&A. David is back as well, so we'll open it to the floor.
Vielen Dank, Alex und David, für eure Präsentation. Starten wir direkt in die Fragerunde. Kommen wir zur ersten Frage. Änderungen in der Zentralbankpolitik wirken sich auf die Märkte aller Anlageklassen aus. Was bedeutet das für eure Produkte?
I mean, it's generally positive for our type of business in terms of that we have very many thematic growth ETFs, which obviously benefit from initial interest rate cuts. We've seen some stronger market breadth since the Fed has initiated its 50 basis point cut. Obviously, there's more to probably happen. Now probably consensus will prevail and that we'll have 25 basis points November and December, but it will be very economically dependent. But the rate cutting cycle is definitely positive for growth stocks and our portfolios in that regard.
Vielen Dank. Kommen wir zur zweiten Frage. Werden eure Produkte an der SIX Swiss Exchange gehandelt?
Genau, ja. Alle unsere Produkte handeln an der SIX. Es gibt jetzt einige Produkte, die wir jetzt neu lanciert haben, also den European Infrastructure Development, den Artificial Intelligence ETF und den Defense ETF, die werden jetzt auch bald auf der SIX gelistet. Genau.
Vielen Dank. Kommen wir zur letzten Frage des heutigen Abends. Sind eure Produkte bei Brokern und Handelsplattformen handelbar, zum Beispiel bei Swissquote?
Ja, auf Swissquote sind alle unsere Produkte handelbar. Was ganz spannend ist, wir haben auch einige Partnerschaften mit einigen Plattformen, wo wir Sparpläne anbieten. Auf der deutschen Seite ist es zum Beispiel die Comdirect zum Beispiel, aber auf der Schweizer Seite haben wir noch keine Sparpläne, aber das steht auf jeden Fall in Planung. Genau.
Wunderbar. Ja, liebe Zuschauerinnen, liebe Zuschauer, Sie sind scheinbar fragen- und wunschlos glücklich. Deswegen neigt sich unser Online-Seminar nun dem Ende entgegen. Vielen Dank für euren Vortrag und die ausführliche Beantwortung der Fragen eben in der Fragerunde, Alex und David. Ich möchte Ihnen, liebe Zuschauer, noch den Hinweis geben, dass dieses Seminar aufgezeichnet wurde. Sie können es sich jederzeit also noch einmal anschauen. Den Link zur Aufzeichnung und zu weiteren Informationen über diese gesamte Webinarreihe erhalten Sie morgen per Mail. Ein Aufzeichnungsartikel wird ebenfalls morgen Vormittag auf der Startseite von Finanzen.ch erscheinen. Alex, ich möchte dich noch um ein Schlusswort zu unserem heutigen Abend bitten. Was möchtest du unseren Teilnehmern mit auf den Weg geben?
Ich glaube, Alex ist schon weg. Ich sage nur kurz, ich springe einfach rein. Ich wollte auf jeden Fall allen danken. Es hat uns sehr gefreut, zu präsentieren für euch. Falls Fragen auftauchen, meldet euch gern bei uns und ansonsten, genau, wir hoffen euch natürlich auch alle nächstes Jahr nochmal zu sehen.
Vielen Dank, David, fürs Einspringen.
Sehr gerne.
An dieser Stelle möchte ich mich nochmals bei euch beiden für eure Expertise und eure Zeit bedanken, die ihr uns heute Abend gewidmet habt. Ich wünsche euch einen schönen Abend und selbstverständlich alles Gute. Und auch bei Ihnen, verehrte Zuschauer, bedanke ich mich recht herzlich für Ihre Teilnahme an diesem Webinar sowie dieser Webinarreihe. Ich freue mich darauf, Sie in einem unserer nächsten Webinare wieder begrüßen zu dürfen. Bis dahin wünsche ich Ihnen viel Erfolg mit Ihren zukünftigen Investments. Ciao und bis zum nächsten Mal hier bei Finanzen.ch.